Edexcel AS Business Studies Revision Screencast 5, Unit 1.3.5, Financing the Business Idea. In this unit, you need to know why a business might need to raise finance, internal sources of finance, external sources of finance, appropriate sources of finance for a sole trader versus a private or public limited company, and you need to know about the implications of unlimited and limited liability. So we'll begin with why a business might need finance. Well, quite obviously they might need finance when the business first starts up, so they might need to pay their setup costs and buy the equipment, the materials, the premises that they need to start their business. A business might also need finance if they're suffering cash flow problems. So these might have been already identified in a cash flow forecast, but we're talking about a situation where a business doesn't have enough money coming in to pay the bills it needs to during that month. So we're not making a judgment about profitability, we're making a judgment about money coming in versus money going out. So in that case, the business might need to raise some finance to solve that problem. So that might be in the form of an overdraft, it might be in the form of longer trade credit terms, it might be perhaps a loan is required, a short-term loan, so they might do something to solve those cash flow problems. A business might also need finance if they want to expand. So build larger premises, take over another premises, buy another machine, train more staff, so they might need finance to expand. So sources of finance can be split into two categories, internal and external. Internal sources of finance originate within the business, and they include retained profit, sale of assets and working capital. Retained profit is the profit that's kept within the business after all the costs have been paid, after interest has been paid on any debts, after tax has been paid and after dividends have been paid to shareholders. What's left is known as retained profit that can be kept within the business and used as a source of finance in the future. Sale of assets means selling things that the business owns. So clearly, selling assets like machinery, could be a source of finance but would then limit their production capacity. Working capital we've come across on the balance sheet, and working capital is calculated by current assets take away current liabilities. Current assets include stock, debtors and cash. Debtors are customers that owe you money but have not yet paid. Current liabilities are debts that need to be repaid within 1 year, within 12 months. So, with working capital, we can use that as a source of finance if we can get customers to pay us before we have to pay our suppliers. External sources of finance involve parties outside of the business. So, loans and overdrafts initially come from the bank, although not necessarily. A loan could be something that you gain from, friends or family, but usually a loan is money that's borrowed from a financial institution like a bank and repaid with interest. An overdraft is an agreement with the bank where you can spend more money than you have in your account, and it's a good short-term source of finance because you only pay interest when you're actually using the overdraft. A share issue happens for private and public limited companies. It only happens for those two types of companies because they're the ones that are owned by shareholders, and a share issue is basically issuing more shares, so inviting existing shareholders initially and then new shareholders to put more money into the business. A mortgage is a loan for buying property. A debenture is a long-term loan, usually secured against property or other assets. So debenture is a posh word for a long-term loan. Venture capital, if you think Dragon's Den, so Dragon's Den of venture capitalists. Venture capitalists are people who specialise in lending money to more risky or innovative businesses, usually businesses that the banks are not interested in lending to, but venture capitalists are usually wealthy people who like the kind of thrill of taking the risk and seeing something happen. So, like the dragons on Dragon's Den, they invest money into new business ideas with the hope that they are going to see higher profit returns in the future. Factoring is when you sell your outstanding customers' debts to a specialist debt collection company. So you could sell, if you've got debtors, if you've got customers who've not yet paid, obviously if they've not yet paid they owe you the money but you haven't got the money. If you need to get your hands on that money, you can sell invoices to a factoring company. So let's say the invoice was for £1,000. A factoring company might give you £800 today, and they will buy that debt off you. Then they will specialise in collecting that debt, so they'll have their own solicitors, bailiffs, etc. They will collect the £1,000, and obviously the £200 difference is their return. So you don't get the full true value or face value of the invoice, but you do get money back more quickly. So that might be a source of finance. Leasing is when you pay to hire equipment but it never actually belongs to you. So that's a good option if you don't want to have to pay any servicing or maintenance costs. Hire purchase is similar to leasing, although when the final payment is made, with hire purchase the item will belong to you. So many people use hire purchase to buy a car. So they pay a monthly payment, and all the time that they're paying those monthly payments, the car doesn't actually belong to them. But when they're asked at the end of their 3-year period to pay the balloon payment, they can either hand the car back, in which case they lose nothing but they've gained nothing either, or they can pay the balloon payment, so the couple of £1,000 at the end of the agreement, and then the car will belong to them. So with hire purchase, eventually the item belongs to you. Trade credit is when you're allowed to take goods or materials without paying for them at the time, and you pay for them by invoice at the end of the month. So that's usually how businesses buy things. They don't usually pay up front, they usually pay on an invoice. So they would get some trade credit. And when we were talking about working capital before, we're talking about payment terms. So usually invoices come with 30 days net or 60 days net. So it tells you when you have to pay that invoice by. So with working capital, we're looking at trying to offer lower payment terms to our customers than we receive from our suppliers, so we can receive the money from our customers before we have to pay for any of the materials. That would be the ideal, although in reality it's not always easy to offer short payment terms to customers, because obviously if they're businesses, they will be looking for longer payment terms to manage their cash flow. So there's our internal and external sources of finance. So thinking about a sole trader versus a private or public limited company. A sole trader is a business, an unincorporated business that is owned and controlled by one person. They're quick, simple and easy to set up. You don't register with anybody, but it means with a sole trader and with a partnership, the business and the individual are seen as the same in the eyes of the law, so they don't have separate legal entity. A private limited company and a public limited company will be registered with Companies House. They will have gone through the process of incorporation, filling in memorandum and articles of association, which get the company recognised in the eyes of the law as separate from the owners. So private and public limited companies are owned by shareholders. In a private limited company you have to be asked to buy the shares, but in a public limited company it's usually a much larger business. Public limited companies need to have at least £50,000 of share capital before they can begin trading on the stock exchange. But in a public limited company, anybody can buy the shares. So it is much easier for a public limited company to raise finance. And the way they raise finance is through issuing shares. Okay, so share issue is not appropriate for a sole trader. They could invite somebody to become their partner, so their business would then become a partnership, but a share issue is not appropriate for a sole trader or a partnership because they're not owned by shareholders. Share issue is only a suitable source of finance for a private or public limited company. Now, the good things about a share issue are that you can get capital into your business that you don't have to repay. However, the more shareholders you have, the more pressure you are under to pay dividends at the end of the financial year, and that will be particularly important for a public limited company, because if they don't pay dividends at the end of the financial year, it's likely that people will want to sell their shares, and that will cause the share price to fall, which could put them at risk of a takeover. So the main difference between these types of businesses is that a sole trader and a partnership have unlimited liability, which means the owners of the business are personally responsible for the debts of the business. So their personal possessions could be taken to pay the debts of their business. So with a sole trader and a normal partnership, house car savings are at risk if the business cannot pay its debts. With private limited companies and public limited companies, they have limited liabilities. The shareholders have limited liability, which means the owners of the business only stand to lose what they've invested in the first place. Their personal possessions are not at risk. So, we've looked at why a business might need finance, internal and external sources of finance, and we've discussed appropriate sources of finance for a sole trader and a private or public limited company. And we've mentioned here at the end the difference between unlimited and limited liability. So you just need to keep clear that unlimited liability means that you are personally responsible for the debts of the business. So that might influence the sole trader's choice and level of debt. Whereas limited liability means the owners of the business only lose what they've invested in the business, which could still be a substantial amount, but their personal possessions are not necessarily at risk. So, looking at things like loans, overdrafts might be more of a viable option for these type of businesses. So, I hope this has been useful. Good luck with your revision, good luck with your exams, and thank you for listening.